Tesla, what's going on here? This is the story of the week, the story of the year. It's been going on for a while now. But the rally we've seen so far is perhaps one of the largest we have witnessed in Tesla's stock history. But remember, every time we saw an impulsive rally in Tesla, we saw either consolidation after that or a significant correction. Case in point, back in the summer, after the stock split mania, we saw the name rallying significantly, only to go down in a double digits correction. We have another mania here, another rally. You can call it the S&P 500 inclusion rally. You can call it the Stimmy rally, buying all these call options to insanity. It doesn't matter. Moral of the story is the stock is going to face a correction imminently. And remember, my line in the sand is the RSI level of 84. We are now at 83 and change. Close enough. Meaning that as soon as Monday, I will deploy a short trade against Tesla via put options. Now, the bullish scenario for Tesla is to go down to the same resistance upper limit of the range trend line that's been battling for a while, retest it for support, and then blast higher. If that doesn't work, perhaps going all the way to 599 and then bounce higher. Breaking the trend line, then breaking 599, that will be the ultimate bearish signal for Tesla. So you have to watch out for that. I got a question on my Twitter page whether I'm shorting Tesla via options or short selling the stock. Short selling the stock at this point is very, very expensive because if you want to short sell the stock, you got to at least short 1,000 shares to make it worth it, meaning that it will cost you over $800,000 plus you got to put about $200,000 to $300,000 worth of margin reserve because this is a very volatile stock. So you're going to commit over $1 million of your portfolio for this trade alone. What if the stock doesn't decline right away and we see more gains? Now you have your money locked up in this trade. You cannot make any other trades. This is why I'm doing it via put options first to define the risk. And by the way, for the skeptics that Tesla only goes to the moon and there are no corrections, bro, go back earlier in 2020. Tesla had an impulsive rally to the upside, granted, but it also had over 65% correction. The stock went down 65%, lost more than half of its value. That could happen again easily with the current extension in the stock. So what are we doing here? Here is the bearish trade that I'm looking at. Number one, I'm buying the 600 puts. That is around the support line of 599. I am buying expiration date February 19th. I am paying about $12 a piece to enter this trade. At the same time, I am selling the 600 puts, expiration date January 29th. I am capturing about $5 for this trade to lower my entry trade. The third leg of this trade will be selling the 500 puts, expiration date February 19th, meaning that this is going to be a calendar put debit spread hybrid. Now, the likelihood is your broker is not going to let you do that unless you have a lot of money to cover for margin and collateral. What your broker is going to allow you to do is start two legs of the trade first, meaning you'll buy the 600 puts expiration date February 19th, and then you're going to sell either the 500 puts expiring February 19th or the 600 puts expiring January 29th. The way I'm doing it is buying the 600 puts expiration date February 19th and then selling the 600 put January expiration 29th, meaning that I'm starting with a calendar put. And then as the stock continues to decline, perhaps if we reach January 29th expiration and we are trading at 720, 680, etc., the 500 put will appreciate significantly in value, meaning that by the time you sell the second, or in this case the third leg of the trade, the 500 puts expiring February 19th, you will probably capture more credit than 5.5 that you see on the screen right now. You'll probably capture $8, even more than $10. All in all, you're gonna get to a point where you actually got paid for this trade, meaning that at that point you could give a rat's ass whether the trade is gonna work or not because you got paid to enter the trade. I know it sounds complicated, but it's not that complicated if you're an experienced option trader. If you're not, I understand, that's totally fine. But if you are been trading options for a while, I think the structure is very clear here. And even if you do it all together on the same time and you sell the 500 puts expiring February 19th for the price you see right in front of you, about 5.5 bucks. Your total entry cost is about $1.50. Meanwhile, your profit potential of Tesla collapses all the way back to 500. Remember, they have earnings in February. If the name collapses all the way down to 500, your profit potential is massive. It is $100 a piece. You're investing $1.50 with the potential to make 100. If you do it the way I'm going to do it, you're going to get paid to enter the trade, and then your maximum profit potential at $100 per option. Enough said. Now, let's move on to discuss a trade for Tesla shareholders. Perhaps you're looking at the chart and you're saying, oh, the stock rallied significantly. I'm afraid of a pullback. Should I sell all my stock? Should I sell some? What should I do here as a strategy? Here is what you do. And this is, of course, assuming that you own 100 shares or more in Tesla stock. You cannot do it if you own less than 100 shares. Very important. You are going to sell the 1,000 calls expiring January 22nd, and you are going to get paid $20 a piece or $2,000 per contract. And you are going to buy the 600 puts expiring February 19th, the same one that I'm buying for the bearish trade. And you're going to pay about $12 a piece or $1,200 per contract. All in all, you are going to get paid for this trade. Again, you're going to get paid for this insurance policy. Are you stupid enough not to take it? You're going to get paid $8 a piece or $800 per contract if you do this trade. And the beauty of this structure is that, let's say Tesla declines significantly, it goes down to 700, 600, even below. That 600 put will appreciate significantly in value, and you can capture your profit and close that trade at any time you please to lock in your profits. The only downside to this trade is if by January 22nd expiration Tesla finishes above 1,000, guess what? You're going to have to sell your shares for $1,000. Is that bad? No, it's not. You're still making a you-know-what amount of money. $1,000 a share is beyond your expectations. Let's be honest here. But the beauty again in this structure is you're capturing a lot of value from selling that call option, and the likelihood is Tesla will not finish over 1,000 by January 22nd. It will have a correction. So you're almost guaranteed here that you're going to capture at least $20 a piece in credit. And then you let the 600 put accelerate in value. You can sell it at any time you're satisfied with your profits. It's pretty much risk-free, assuming that you have 100 shares or more in Tesla. If you have 100 shares, you can sell one contract. Got 200 shares, you can sell two. What you cannot do is, if you have 100 shares, you sell two or more contracts. Again, please, if you're not familiar with options trading, do not follow these trades. Only follow them if you understand what I'm saying here and you are experienced in options trading. Enough said. By the way, before we move from Tesla, here is Michael Burry. Big short investor Michael Burry predicts Tesla stock will collapse like the housing bubble. Quote unquote, enjoy it while it lasts. Again, you think you're smarter than this guy? This guy has been trading, investing in stocks since you were in diapers. Maybe you should listen to him and follow the trade I gave you to protect your shares from further declines. You're getting paid for the insurance policy.